Hey guys, it's Chris Clothier. It's right now 2 o'clock Central Standard Time. Wanted to jump on and do a quick live video to the group. Welcome to REI Nation. Hopefully REI Nation out there, everybody's doing good. Look, this is something I want to kind of apologize on the front end because I'm trying to figure out exactly how to do this. I've got questions on one side where I'll be able to see you guys putting questions in or posting things, and I'm trying to look up and look down, so forgive me if I'm looking all around. Look, as we get started, a couple things real quick. Number one, as you come on the video, if you want to, I would appreciate it. Say hi. Let us know where you're from, city and state. You might find that there's other investors that hey, look, they're where your parents live, or you just moved from that town. You might even find another investor across the city you didn't even know was in the same area you're in. It's just getting social out there. So let us know where you're from. Also, if you get a chance, if the video is good, if I say something that you agree with, hit the like button, hit the love button. You can't share this because this is inside of our private group. But I also wanted to tell you that I'm going to do something different with this particular video. As I'm doing these videos, the ability to ask me questions and us kind of communicate back and forth is just in this group. No one else is going to see that. But I am going to take this video and I'm going to turn it into our My Experience Matters podcast. So the discussion back and forth will be something that others may be able to see, but it also gives them incentive and reasoning to get in here and join the group, because then they can participate live and actually ask questions back and forth like you guys can that are with me. So anyway, make sure that you like it. Make sure you're a part of it. I wanted to be real direct and upfront that I'm going to share this outside of the group a little bit later on. Lastly, guys, look, if you're watching this at a later date, don't feel like you can't ask questions. Be sure and put them in the comments. I get alerted every time a new comment is made. I'm happy to jump in and answer questions. And we'll see, if I have fun and you guys enjoy it and we do more of this, maybe we'll do more Q&As at a later date. Don't forget, tomorrow, I got to say it right now, 2 p.m., same time, same spot, Kent Sr. is doing a interview. Tomorrow he's interviewing 2 investors. One has, I believe, 8 properties and been with us for 6, 7, 8 years. Another long time investor to give good input and feedback on what it's like over the years. And then another investor who really jumped in head first, had a plan and started executing quickly. 18 properties, I believe, in roughly 18 months. So have a great conversation tomorrow with Kent Sr. with those investors. Be sure and join us. Same thing when you get on. Let us know where you're from. Communicate back and forth. Say hello to each other. Welcome each other as well. And then also, if you want to, jump on and ask questions of those investors. So look, for today, what I did was I went back through our group, and there have been some questions asked in the group from people that are looking for some feedback, I guess, and they want us to answer some questions about particular topics. You see them right here. I got to figure out how this works. You see them right here over my shoulder over here. We've got the whole getting started. Look at that. And then we've got the LLCs right there. And then we've got the building your portfolio. So look, in the group so far, there have been questions asked about, hey, can we share some getting started stories? So I thought today, I'm going to share my getting started story. Because it's, I don't know. I just thought that you guys might find it interesting to know exactly how I got started and tell you a little bit about how the first investor got started, Memphis Invest, and maybe even, kind of help investors on here understand, because I talk to a lot of different investors, and I can kind of tell you what it's like as you're getting started, especially with such an unknown, with a company that maybe you haven't met yet. Maybe you only know us through this type of interaction or over the phone or through reputation. So how do you do that? And the other thing, I'm going to talk a little bit about LLCs and insurance, because somebody asked, about the specifics of using an LLC, and I thought I would dive into that just a little bit, and then building your portfolio. I've been in a discussion all week in a different forum with somebody about the advice they give about building a long-term portfolio, and I'm not going to say who's giving the advice because it doesn't really matter, but I'm going to discuss it a little bit because to be direct, I thought the advice was pretty poor, and I thought it was a little bit too salesman-y, and I thought it was a little too much showmanship, too much glitz and glamour, and using all these, funny phrases that they've made up to describe investing, when really this is pretty basic. And so I thought, just for us and for my group, I'm gonna share a little bit about the advice that was given and what my take on it is and what advice I would give. So I didn't think any of these topics were necessarily great topics for going long term, for talking for 30, 45 minutes, but I thought I could easily do this all three of them and spend some time here with everybody. And I'll stay as long as you guys want to ask questions. So first, getting started. Look, 2003, the most interesting part of the way REI Nation started was the fact that we all did it independently. We all did it separately. So, and when I say we all, I mean that myself, my father, my older brother, Kent and I were the kind of the first two selling houses for Memphis Invest. We were the first two talking to other investors about it. Kent was doing it in Florida. I was doing it in Colorado. But while I was investing in Colorado, my brother was investing in Florida, my dad was investing in Memphis. None of us were, communicating on doing anything together. We were just all kind of doing our own thing with our other businesses. Me in particular, I had really no need or desire to get into real estate. It wasn't something that was on my radar. I was sitting in a hotel room in Denver, Colorado, because at the time I lived in a hotel, 300 square foot hotel room with my wife and my 11-month-old son. And the reason why was because we had gone to Colorado. I had taken what ended up being a very short term, the first time I've ever really worked for somebody else other than either my dad or myself. And it was interesting. So I took this job with this company, and they gave me a hotel stipend until I sold my house in Tennessee. Well, it took us forever to sell our house in Tennessee because we had this, for whatever reason, we had this house outside of the city on some land. It's a very special kind of house that not everybody was really going to want. It wasn't in a neighborhood or anything along those lines. So anyway, I've been in this hotel for close to 8 months maybe, and I'm sitting there late night watching an infomercial, and it's Carlton Sheets. So if you remember Carlton Sheets, just throw me a little hand wave in there in the notes, because that's old school. That's a long time ago with the late night infomercials with Carlton Sheets on how to buy real estate, how to invest in real estate. And so I see this, and it's a few dollars, so it's not much. So I go on ahead and I jump in there and I buy it. I spend the money. I get the Carlton Sheets program. It gets delivered to the hotel a few days later, and I mean, honest as the day is long, I only looked at one of the videos and a couple of the pamphlets in there. But I got an idea out of there that absolutely would change my life. So look, there's value in those things. There really is. There's value in something like that. I got one idea that would literally change the trajectory of my future. And it was about trading houses, was his idea of getting started by trading houses with somebody. If you had something that you needed to sell and you wanted to get into something that might be an investment property, you trade the properties to create the win-win scenario. For me, after 8-9 months, however long it was, I got a buyer who came and looked at my house and said that they loved it. They were from the city, in the center of Memphis. They lived within a block of Rhodes College, and they made me an offer on my house contingent on them selling theirs. And I looked at it. It was a full price offer. It was good. I thought, wow, they're contingent on selling theirs. So I asked my agent, I said, well, what's going on with their house? Where's it at? Is it even listed? What's happening? And she came back and said, it's been listed for a while, but it's kind of a fixer-upper. It's not real, that needs some work. And she said it's within a block of Rhodes College. I said, well, give me an appointment. I want to go see it. And she said, why? Why would you want to go see their house? Because I was living in Colorado. And I said, because I want to look at their home to see if I want to buy it. And she thought I was out of my mind. I mean, she looked at me like, are you crazy? You're actually going to buy somebody else's house? And I explained to her, I said, look, I've got a house that's selling for here. They've got a house that's for sale for here. So if I got a house that I can't rent, but they've got a house within a block of a college, I might be able to buy theirs, enable them to buy mine, and then I rent the home for income. As it turns out, it was, I think it was 1243 Rainbow. I don't know the exact address. It was Rainbow Avenue in Memphis, Tennessee. Like I said, a block from Rhodes College. We did the deal. I bought their house. They bought my house. I suddenly owned an investment property. Didn't know what the hell I was doing with it. Sorry for the language there, but I didn't know what was going on. I bought it. It was a unmitigated disaster for the first year. I will tell you directly, because I tried to do everything on my own from a distance. It wasn't too much longer that my dad and I are talking, and he's getting really into real estate. He's doing a lot with what was the precursor to Memphis Invest. And I ended up getting his help getting it managed. He found the management company that he was currently using. They took my property on, and it became a really, really good investment property for me. It was one of my better ones for a very long time. but I had no interest in real estate up to that point. I got into it strictly as a way to fix one problem. I had a problem, I couldn't sell a house, so I'm living in a hotel because I couldn't buy one in Colorado. What was interesting was that when I bought the house in Memphis and got it rented, that rent qualified me to buy another home in Colorado for my personal residence. So I used real estate and the creativity that I learned from Carlton Sheets to get started. For a lot of investors that may be watching this right now, and I'm gonna check here real quick and just see if we have any questions just yet. Hey, Alvin, how are you, sir? And then I see Paul and multi-unit investor and John, Taz. Hey, everybody. I hope everybody's doing well. I don't see, and of course, I'm not the greatest at doing this. I don't see any questions at this time, so I'm gonna keep just right on rolling. Look, getting started. So the investor that asked the question in our group, I really think was trying to figure out, how do you get started with a company like Memphis Invest? And from, at this point, having spoken with hundreds, if not well over 1,000 investors, many that are on this call or in the group, the reasoning for getting started is often, it just comes from desire. That desire to be able to, whether it's build a legacy, whether it's to be able to replace income, whether it's just to change even a little bit lifestyle. Real estate is a fantastic avenue to build wealth. Getting started is harder because there's literally thousands upon thousands of pieces of information and places you can go to get things, from reading on the internet to reading books at the library to consuming podcasts or videos like this. But how do you really get started? And I can tell you this, that the investors that have gotten started with Memphis Invest, they've all done two things. All right, so we'll call, there's this hill, and you find yourself on one side and you've got to get to the other, okay? And getting over that hill is where you can buy the property. And the hill is the comfort level of buying a piece of property that you don't pick out yourself. You don't participate in the renovation of that property. You're not going to participate in the ongoing management of it. And you are entrusting each of those processes to someone else. That's a steep hill for a lot of people to be able to climb. Like, how do you get over that? The getting started part is, it's all one step after another. I'm not going to give you those silly platitudes about, eating an elephant one bite at a time, any of that kind of goofy stuff. I'm going to tell you that the way to get started is to decide you're going to get started. And getting started is the decision making. My son is 18 years old this year, just graduated high school, and he had to pick a college and was having a lot of trouble with it. We knew that he was having trouble with it. He was bouncing between 3 different colleges, and he wants to be an airline pilot. So he was trying to figure out, which college am I going to go to? He settled in on staying in Memphis at one point, but my wife and I, his mom, we figured out that maybe he's doing this just as a settling thing because he can't decide. He can't, get started in his college journey. And so we sat him down one night and I told him, I said, son, that the way you're going to pick the college you want to go to is you have to get started on picking the college. You have to take control of the process that's going to get you to your decision to say yes. And because at the point he was relying a lot on others, he was relying on us and friends and maybe teachers to tell him what to do. And I told him, I said, take control of the process. Create your positives and your negatives column. I said, create your notebook where you're starting to write down your thoughts about the good and the bad and what are your questions you have about where you're going. I told him, do your research. You decide what matters to you most. And in all of this, you're not picking your college. You're going through the process of picking the college you're going to go to. For him, it worked. It got him away from deciding he was going to go to the University of Memphis and got him onto Arizona State University. That's where he knew was the best place for him to be successful in what he wanted, which was to become a pilot. For real estate investors, it's much the same. The way you get started is you take control of the process of making your decision. It can be, I wrote a book, I don't have it here, I don't have a copy of it, not that it matters, called The Turnkey Revolution. And in the book, it talks about you have to pick the city you want to be involved in. You need to find and interview the company that is going to be the best fit for you. You don't necessarily have to pick the house, but you have to start these down the road of these things that give you confidence in where you're going and what you're doing. So as an investor getting started with Memphis Invest, it's all about confidence. It's all about, is this company going to do what they say they're going to do? Are they going to listen to my needs as an investor and help me pick a house that fits my needs? Not just any house, but one that truly fits what I'm looking for as an investor. We had an investor in our offices today, believe it or not, that came in with all the mask and washed their hands and kept socially distanced, but they really needed to see that there was a real company behind this as part of their decision to move forward. And I think it really built their confidence after coming in and doing this, because they've done a lot of due diligence up to this point, but seeing it in person meant a lot to them, really helped them get over the hump. That's how you get started. Look guys, this is not, it's not rocket science. These are houses. This is investing. So many of the rules that apply to making a smart buying decision apply to this. There's some subtle nuances. It's a little different when you are relying on somebody to be turnkey, simple, passive, and have some sense of security with your investment. So there's a little more to it, of course, but it's really a process of getting started. And then you'll know when you kind of eclipse the hill and you're on the other side and you say, hey, I feel really good about this. Like I've done my due diligence. I've done my homework. I have answered the questions that are most important to me, and I feel good about this company. So that's how you get started. Anybody else that wants to share on their getting started story, go in there, go in the group, share. This is how you got started, how you met the company, or how you bought your first house, because not everybody owns just with REI Nation. That's fine. Share it. I would love to read other people how they got started. I'd love to read your Carlton Sheets stories. There was a gentleman that asked a question about using an LLC to buy real estate. I'm not going to talk a long time about this because I think it's fairly simple, and I don't mean to downplay the question. I mean that a couple things. One, you should always have advice of your attorneys and your CPAs, anybody that you truly trust to help you build a portfolio, build long-term wealth, do estate planning or retirement planning. You should have team members that are a part of your team and understand what it is you're doing. Not all of them will fully understand what we do and the service we provide, but most will. But no matter what, make sure that you always get that advice. I don't want anybody to construe anything I'm saying as legal or otherwise kind of advice. But all right, so an LLC. They are relatively simple to get, simple to use, but they come with a massive caveat. And that is they come with rules that you have to follow as the owner of the LLC. Now you get it, it's hard for you to read, but I wrote up here, protection and anonymity. So people get LLCs for two reasons. For protection of their assets and also for anonymity so that nobody knows who actually owns the asset. Now that can be for lots of reasons. It's not due to some people are just more private than others. Some people do it for asset protection, that kind of thing. Look, whatever you do, know two things. You do not have to have an LLC to buy real estate. I have owned dozens of properties without an LLC. I always owned in my own personal name. People would say, wasn't that risky, or weren't you scared of being sued? Because I went to this seminar or listened to that guru and he told me that 1 out of every 7 people in the country gets sued, and real estate investors, it's 1 out of 2, and you'll get sued on average every so many months. And by the way, for $4,999, I'll sell you a do-it-yourself home kit to set up your own LLC. It's a sales technique. Look, I don't know the stats and the likelihood of anybody on this call being sued. I don't know. I do know that as an investor, I've been sued one time. And no insurance had to get involved. Settled it out of court. Somebody wanted their deposit back after absolutely destroying my home. And the easier and cheaper option was to give them the deposit back than to go through the court fight. But the reality is, I don't know the likelihood of you getting sued. I don't know if you will or won't. I don't know. But I know that the LLC doesn't necessarily give you any massive shielding protection, okay? It can. You have to use it correctly. You have to keep up with the rules. You have to keep minutes of your board meetings. You have to actually physically have a board. You have to follow the rules that are laid out in your LLC and keep it up to date, keep it filed, keep it paid for with the state. And the costs are usually minimal, so that's not a downside, but it's just you have to do these things in order for the LLC to actually be functioning and real and give you the protection that you're looking for. Anonymity is another thing. A lot of people think that LLCs keep them shielded and private where people can't find out who they are. The reality is that's not true. That there are so many things that you will sign for with your home, with your personal name, and oftentimes things you'll sign for that get filed. Okay, that means they're filed with the state, they're filed with the city, they're filed with the municipality, they're filed with whether it's the light, gas, and water, if it's the trash pickup or whatever ends up happening. There's all these different places where your name may be filed. And even if you buy in the name of an LLC and you take lots of different steps to protect your name, somewhere down the line, it is listed as to who owns that LLC. There's steps I won't even go into that you shouldn't take anyway, that I guess somehow to be able to hide those things, but I don't go down that route. Unless you want to give up control. If you want to give up control of your LLC to somebody that you really trust, that's a different story. I don't have time to go into that. That's the legal advice you need to get. I'll just tell you this. I owned a lot of houses in my own name. What I kept instead of an LLC was that right there, insurance. I kept insurance on my houses. I made sure that I was overly insured. I made sure that I was layered with my insurance so that the house was protected. I was protected. Any other things that I owned, from my kids driving cars all the way around, I had these umbrella policies that cover everything, so that should something bad happen, should somebody choose to sue me rightly or wrongly or whatever, I was covered. I had the protection I needed that I paid for in the insurance. Today I do use LLCs, just so we're clear, but I don't have an LLC per property. I've got an LLC that I hold investment real estate in. That's just what I choose to do. Over time, as I got bigger and had more value in the houses themselves, I chose to put them into the LLC, and I constructed it in a way that, again, I could easily follow the guidelines and the rules to help that LLC stand up in place. But just understand, you don't have to have an LLC. There's nothing that's massively different. It's harder to find a lender to lend to you in the name of an LLC, but it's not impossible. You can do it. LLCs are easily put together by attorneys. I'm not 100% sure, but I'm fairly sure that every closing attorney that we use could assist you in putting together an LLC for a fee for their service, of course. But it should not be anything exorbitant and outlandish and crazy, okay? You shouldn't be paying thousands and thousands of dollars for LLCs. You just shouldn't. It's unnecessary. So we'll leave it at that. But I'm not convinced that you need one, especially just starting off. If you've got 1, 2, 3, 4 properties like that, a smaller portfolio, I would stick with insurance first. That's the number one protection you can have against any issue that should come up. Should you choose an LLC, it's relatively simple. They're easy to use. It's just like buying it in your own name, except for you're buying it in the name of a corporation instead. Okay, it doesn't really change a lot after that. Now, we've been on here for I don't know how long we've been on here. I'm laughing because I don't exactly know how to always use these things, but all right. So look, I'm going to switch over here real quick, and we're going to talk a little bit about building your own portfolio. Building a portfolio. So I was reading something recently where this week, in fact, where a guy was giving advice, and he still gives advice to people about refinancing over and over and over and over again. So you've got a property. It goes up in value. You refinance it, take your original investment out, do whatever you want to do with it. Go buy another property. It goes up in value again, refinance it, always refinancing up to the maximum you can pull out on a property. So always keeping your house leveraged as high as the value, as much as you can. No thought at all towards what the rental rate is and how far you're expanding away from it. Always suggesting you take that money out and you go buy more assets with it. And then with those assets, you leverage them up to the maximum capacity. Look, I don't think I have to say a whole lot more about the questionable level of that advice, I will say this, that when you're trying to build a portfolio, the ability to use the same dollar twice to buy two homes is really powerful. Okay, so the idea that you can purchase and then refinance and pull your original down payment out and use it a second time, it's massive. That's a major plus in trying to build out and develop a portfolio. The idea that you should do that over and over and over again and maximizing your leverage, maybe not so much. And the advice given was that if you have maximum leverage and you find yourself in a sticky situation with your bank, they're less likely to do anything to you because you're highly leveraged and they don't want to mess with that. Okay, I'm just gonna tell you on the front end that that's probably one of the dumbest things I've ever heard, and it does not match reality. When you sign a mortgage agreement in that promissory note, you owe that promissory note, and so my advice is never over leverage yourself. If you can refinance a property and not take it too far away from rent so that the rent is still going to cover your note and even bring maybe a few dollars back to your pocket so you can reduce that note faster, fantastic. I think it's a smart idea. If you can use that to purchase a second property, and again, you will not be over leveraged. You won't be buying a property that's too far away from rent. So you're not buying a property in these markets where rent ranges are 25% of value, those types of things, very high-end, expensive markets, but you're sticking with good long-term assets that are, the 0.7 to 0.8 to 0.9 of your rent to value ratio. I think you're good. That's a very smart plan for building out a portfolio. And then at the same time, look, if you really want a portfolio, we all know that saving our way to long-term wealth may not be like this massively great strategy, but here's the deal. You certainly can't spend your way to wealth. You can't borrow your way to long-term wealth, in my opinion. Has it worked out for some people? Sure, absolutely. But it's highly risky. So my advice, in the particular forums, and I was kind of going back and forth on this, was, look, I love leverage. I use leverage to acquire assets, but I always structure my deals to pay that leverage off in the shortest amount of time. I don't care about cash flow. I have a good full-time job. I don't need the cash flow. I want to structure the deal where it'll pay off in 8 to 12 years. So if it were on a 30-year note, it would cash flow. But I don't want that. I want an 8 to 12-year note and reduce principal as fast as possible. I want to pay as little interest as possible because interest will be the single biggest expense you have while you own a property that is leveraged. So I want to get rid of that. I want to own the asset outright. And then, of course, if I own a $150,000 asset outright and I borrow at 50%, I might have enough to buy two properties rather than just one. And then I only have that particular property leveraged at 50% of its value, which keeps me well below any threshold that puts me at risk. So for me, building a long-term portfolio, number one, should be about long-term. Long-term means it's a 7 to 10 year hold. Short-term for me in passive investing means 3 to 5 years. So if you're going to build a long-term portfolio, wanting to hold for 7 to 10 years, think about it in terms of what can I produce over the next 7 to 10 years. You might buy your last property in year 10. You can't worry about what the prices are going to be then because you can't predict it. It doesn't matter. You just build a plan that gets you there, that says in year 10, I should be in position to buy that 10th property. It's highly probable that done right, when you buy that 10th property, you own multiple properties already. You don't have 10 mortgages. You may at that point only have 6 mortgages. I don't know, but it's very doable. It can be built that way, and that's kind of where you're stacking the incomes of each property on top of each other to pay down debt as fast as possible. Nothing new. There's nothing proprietary about that. That's a debt structure and a plan that's been around as long as investing has been. But my point was this whole idea of you just keep refinancing, just pulling all the money out that you can because it's tax-free. It's not income. That's borrowed money. So make sure that you don't borrow too much. Make sure you don't over leverage yourself. Make sure that you're smart when you do that and you pull money out, you pull it out for a purpose. The purpose is to hopefully acquire more assets at the lowest amount of leverage that you can so you can build something up. Look, guys, I want to, if anybody's on here, I know there's a few people watching right now. If anybody's on here, if you have questions about like the start of the getting started, or how do you use an LLC, or the building your portfolio, or anything in particular about those, I'm all up for answering any questions. This is the first time we've decided to go live with a Q&A type thing. And so again, you know, when we got Kent Sr. on there and he's interviewing somebody, and there's been a few questions here and there, and I know everybody watching is getting used to, hey, how do we do this? How do we interact and ask questions and get Chris or Kent Sr. or whomever's on there to kind of have a discussion back and forth. We're willing, open, ready to answer whatever we can, you know, kind of answer there for you. And I didn't come into today with any planted questions, as you can see. So I'm not seeing any questions either at the time. Hopefully I gave some decent, I'm gonna look at it this way. Hopefully I gave some decent information here. Hopefully the lack of questions isn't a indication of how bad I was at just giving my information out there to everybody. Let me go over here and I'm going to open this up right here. All right, hey Jeff, you're asking, is it harder to get a 15-year loan for investment properties versus a 30-year loan? Harder is probably not the right way to structure the answer, I guess. With lenders, what they really want is they want that 30-year note, because it's easier for them to sell on the back end. It's easier for them to package up with other 30-year notes and sell. So the 15-year mortgage is generally going to come maybe a quarter of a point higher. May come with a little bit higher fees, but not always, but not necessarily harder to get. The 15-year loan is just as available as a 30-year loan. The other thing too, it takes somebody who really is disciplined. Okay, you can get a 30-year note and pay it off like it's like a 15-year. You can pay it off in 12/8. You can do make a payment, half a payment every 2 weeks, which ends up getting you an extra payment in the year. What I do is I like to take a lot of my investment loans. If I didn't put it on a 8 to 12 year note, if I put it on a 30-year note, I'll take the principal and I'll just double it every month. So early on, it doesn't really take my note up very much, but it pays my principal down faster and reduces the amount of interest I pay because the principal is shrinking. So I end up usually getting 1 to 2 more, sometimes as many as 3 notes extra in a year. Or sometimes I will sit down with the lender on the front end and say, okay, that's a 30-year note. We'll take that extra money. We'll build it in and we'll back down the number of years. And I'll say, okay, I give myself no room. I don't give myself any option of being undisciplined. I just say that's the note I want. I want to do this in a 12-year note or an 8-year note, whatever it ends up being. And I'll tell you that really one of the reasons why I do this, I want to be totally transparent with you that I got caught in 08, 09. I had too many houses. I was undisciplined with the way I bought. I didn't follow the plan that I laid out for myself. I let myself be sold by some real hucksters that sold me some poor properties. I had my dad there that was selling me houses. I should have just bought more from him, but I thought I knew more than he did at the time. So I was even though I was already buying from Memphis Invest, which that's an interesting story in and of itself, how my brother and I were really 2 of the first investors with Memphis Invest, especially out of town guys. But I outsmarted myself. I bought houses from other people, and I was buying houses back in 2007 on interest-only notes. I was buying houses with no down payments, 100% financing, and none of it was smart. I wasn't buying with the same attitude I have today. I was buying because I thought I was getting rich. I thought, 50 houses, $200 a house, I'm going to make a lot of money every month. The reality was that I wasn't. I just didn't know it. I was the last one to find out at the time that I was being foolish with what I was doing. And so I ended up with 2008, 2009 having a lot of sleepless nights and you talk about a long workout. That was a crazy time for me. but I made a lot of mistakes as an investor that I don't make today. Today, my investment strategy is very, very disciplined. I will not over leverage, period. I love leverage to acquire. I hate leverage to hold. So I want to own my assets outright. And if I find myself in a position that I need to move quickly, I've got an asset that I can either pledge at the purchase, or I can refinance out or finance some money out of it and use it to be able to buy a property. And I've been able to move very quickly on some deals because I had properties there that I had paid off 100%. So it put me in a really good position to move faster than other investors that maybe had to figure out how to get their financing together. So, man, y'all gonna laugh at me. I think I need my glasses for that. Talk about IRA. Okay. Hey, Jeff. So Jeff's asking, can I talk about using an IRA to purchase real estate? Yes, I can. Look, a couple of weeks ago, I did a video with Horizon Trust, Greg Herline, and he's a gentleman that has been friends with our family for a very long time. Back in the day, 2009, 2010, 2011, I used to speak on stage at Equity Trust when they would do their education events and bring 1,000 investors together to hear from different companies on how to use your IRAs for different investments. Spoke on, gave presentations, did panels. Great group at the time. But look, the IRA is a specialized. It's a specialized way to buy houses, and I'm going to make sure I post the video in the group with Greg so that you guys can watch that and see that and kind of pay attention to some of the things he says. There are a lot of rules that you can and can't use your IRA for as far as buying real estate, but in general, in very general terms, for what we do for the long-term real estate, your IRA is certainly a viable strategy, building inside your IRA to purchase real estate. You can leverage inside of your IRA. It is possible, and there are companies that do it. It comes with its own special set of rules. But the benefit of using your IRA, obviously, as we all know, is from a tax standpoint of the growth inside the IRA that grows tax-free, depending on what your IRA is, whether it's tax-free when it comes out or not. It's a different plan. But the benefit of doing that is that so many people have always thought the IRAs, I can only use it to, if my company owns it, or if I set it up with some company that said I want to put you into my firm's mutual funds or market index funds, that's where we've kept them. There is, believe it or not, there's an enormous amount of money that it sits in IRAs today unused. It's not investing in anything. The idea is it's not being lost either. So it's just sitting. It's safe. It's not growing. It's probably shrinking due to inflation, but at least it's safe. It's not being lost at an investment. So a lot of that money needs to be put to work on something. In real estate, they've created a way through self-directed IRAs for investors to be able to direct their funds into the investments of their choice. IRA or real estate, and passive real estate is one of those. So the benefits, I would say, are the fact that, again, that it grows tax-free. The downside to this is that you have certain rules you have to follow, and you're not able to qualify for traditional financing when you do that. You're going to have to use specialized financing. So here's the funny thing. That specialized financing means generally that there's usually not going to be any cash flow, but you're not expecting cash flow anyway. What you're wanting is growth of the overall IRA. The assets are in there. You want them to grow. So you want to, in my opinion, you really want to buy appreciating assets. So, in terms of our markets, we have markets that appreciate faster than others. They don't generate as much cash flow, but they generate a higher internal rate of return, which will be, is calculated at sale. But like a Dallas, for instance, that market goes up much faster than the other markets in some of our other markets right now. Will it continue? I don't know, but it could. And could the other markets catch up? Sure, they could. But as of right now today, Dallas is a fast appreciating market and one of the faster growth markets that we have. So if somebody is looking to build inside their IRA, self-directed IRA, Dallas to me is a fantastic market to do it in because you can't pull the money out today. You're looking at what's the value of this going to be in the future. So the advantageous or the need for borrowing in most self-directed IRAs, you can only borrow 50% of the value of the asset you're purchasing in real estate. And there are lenders out there that will lend you the other 50%. Well, the benefit of that is that rather than buy one house for cash to sit in your IRA and just let it grow and the rent just grow in there with it, now you can buy two. So the rents won't grow, but and most of these are put on an 8 to 10 year payoff. So let's just go with the 10-year payoff. While you're not collecting the rents are actually paying off the debt that you used to borrow to buy two instead of one. At the end of the program, you now have two houses and no debt and all the rent flowing into your self-directed IRA. If they've appreciated in value, you've got that upside as well. IRAs, there's so much more that goes into this. I'm going to make sure I post that video because I want you to hear from an expert in that particular market or that particular niche. But I love, and we do, about 10% of our sales are with investors that are using their self-directed IRAs to do that. So it's obviously it's a great way to get out there and build your portfolio. So let me look at this, get these back out. All right, so I think, forgive me if I mispronounced your name, I apologize. Nelson said, do you use umbrella insurance for all your rental properties and how many per policy? So look, when I mean an umbrella, so I've got that one policy on the property itself, and then I've got an umbrella policy that covers all of my properties. So it's not again, we don't have to go crazy here. We don't put an umbrella over every 3 houses, that kind of thing. You don't need that. If you're worried about a larger portfolio and the chance that you need multiple policies or more of a policy, just get a bigger umbrella policy. And I want to make sure I say this the right way. That look, like I said, I've had one time that I was taken to court by a resident. That's not to say that it doesn't happen, that it hasn't happened to others. But look, the reality is that, and I did not file insurance at that time. I just went to court to see that, hey, this is much cheaper for me just to pay this. It was below my threshold to file it anyway, so I just paid it. I've never had to use my insurance ever. So, and again, that's on me. Insurance is relatively, it's used relatively rare, but it's, as I always say, when you don't need it, you feel like, what do I have this for? And when you need it, you're glad you've got it. I would insure to the point that you feel comfortable, that should anything crazy happen, I am fully covered. Understand, you kind of tack it into your cost of owning your portfolio every single year. I don't suggest that you overinsure. You just assure to the appropriate level that you're comfortable. And the reason why, again, I talk about that with the LLCs. The fact is, even with an LLC, a good attorney that wants to find out who owns that is going to find your name. And they're going to try and include you if they choose to do any type of lawsuit. So the LLC is money spent that may very well be wasted at the time that you need insurance. And insurance is money that may be wasted at the time that an LLC will keep somebody from knowing who you are. But when you need it, you're glad you have it. Hopefully that made sense right there. That when you really need one of these two, insurance is what's going to be standing there ready for you. And while you don't need it, nobody knows who you are and you're paying for this anonymity, great. But who cares if people know who you are if there's not an action being taken against you? I hope that really makes sense for everybody, that insurance matters when it matters most. And it matters much more, in my opinion, than LLC, and that's through my experience. Make sure you get good advice from your CPAs and attorneys on that, okay? And not just from somebody that's trying to sell you how to do it yourself or sell you a really expensive program. So, look, what time is it? So I've been on here, about 45 minutes. I have time. I don't know if you guys have any more questions. If you don't, that's perfectly fine. If you come on at a later date and have a question, throw it in here. You won't get to see me answer it directly on the video, but you'll certainly have me typing in there, and I'll be happy to communicate with you back and forth. Look, I'm gonna finish with this. We're trying to figure out how to use this group to the best of our ability to be able to help investors. Some are clients, some aren't. We look up now, we're almost to 1,000 members in the group, and not everybody is a investor of ours, but there's many in here. The point of this is, like in a discussion today, is for you to be able to communicate back and forth with other investors that are like-minded. Investors that, if you want to know, is Memphis Invest or REI Nation today, are they real? Is it gimmicky? What do they do when things don't go well? That's a great question to ask. What happens when it's not perfect? Because real estate is not perfect by any stretch. And I can just say on the front end that we didn't earn our reputation from perfection. We earned our reputation on when things go bad. When things don't happen exactly the way that we anticipated with a resident or with an owner. What do we do? How do we handle that? Because that's where you build your reputation. So that's what this is for you to be able to communicate back and forth and meet with other investors in an environment where you're safe. And what I mean by that is there's no ridicule. There's a lot of forums where you get ridiculed. You're going to buy turnkey? What a knucklehead you are. And that's from somebody that doesn't know us or doesn't know you, doesn't know the rationale behind what you're doing. So this is a place to get good information, ask real questions. You can even ask them, one-on-one, and just find out what's the real deal. Is this a good investment for me or not? Is this the right company for me or not? Or is there another turnkey company out there I should be working with that just fits me better? Because believe me, there are. We're not right for everyone. There's a lot of companies out there that are different than us that may be better fit for investors depending on what they're looking for. Okay, so going back here real quick. So what companies do I recommend for umbrella insurance? Look, you can get an umbrella policy from anybody, from Shelter, from State Farm, from USAA, from anybody that provides insurance that they can provide you with a umbrella policy. So if somebody is currently providing you a policy on your personal residence and maybe your cars, maybe health or life insurance, they can also provide an umbrella insurance policy for you. That can be done by anybody. And there again, you may want to shop around, up to you. But you want to make sure that you're very specific with what you want it to cover. Okay? That you got to make sure that you tell that insurance company, I don't want just some like little umbrella policy out here that's not going to cover anything that may actually happen with me. I want it to cover specifically these investment properties, my investment portfolio. So they're going to need to know how you've got that structured, what the names are in the portfolio, who's managing it. They're going to want to know some of these things generally about your portfolio, what the value is, what your mortgages are, what your rents are. They're going to want to know these things. But once they get that together, you want to make sure the umbrella policy specifically covers you in times of need with those properties. All right, so interesting. Matthew's asking if we have any multi-family properties in our portfolio, and I'm assuming you mean myself or our family. And then do we have any plans for the future? So look, great question. The answer is no on both, and I'll tell you why. We've done multifamilies before. We did some duplexes here in Memphis multiple times. I think we did a couple of fourplexes in Memphis. I know we did multiple fourplexes over there in the Texas area. And here's what we learned from those experiences for us and for our clients. That's not our forte. See, and it's not even what we offer. It doesn't match what we offer, the value of doing business with REI Nation. So if you guys know, we have an average 5-year length of occupancy. That we're proud of that. That means a lot to us. So what we found with multifamily was a couple of things. Number one, they command a lower rent. Commanding a lower rent just it means that you're providing a service to somebody that is not looking for the same price point that we offer in our single family homes. The reason why we stick to that price point in our single family homes is that it's attracting somebody that is, let's just say, less transient. It attracts residents that want to really put down roots and stay longer. Oftentimes, 2-income earning families looking for quiet, looking for a little more stability. Multifamily is not those things. Doesn't mean that people that rent multifamilies aren't going to stay. It just means that they stay in fewer numbers. There's a higher likelihood and more transient type relationship with multifamily residents. And so we learned pretty quickly that that's not what we do. We built our team, we've right-sized it to be able to provide the services that we provide. Suddenly, if you've got more move outs and you've got more renovation happening on a faster scale, you need more team to be able to provide that. And then that provides a, let's just say, less than ideal experience for an owner, because now they're like, wait a second, I'm dealing with move outs all the time, and I've constantly got some form of move out costs hitting me. That's not what I come to REI Nation for. I come to REI Nation for the stability, the lack of those things, and suddenly I find I've got more of it. And so that's the lessons we've learned. We've done multifamily in the past and decided that is just not our forte. We're not gonna stick with that for sure. So I don't foresee us ever going back into multifamilies at any point in the future. It's just single families are too good. We're too good at what we do with it. I say that with all humility, but I just think we have a fantastic team that does really well. And I would rather be number one at one thing than be top 5 at 5 things. It just doesn't make sense for us. So, but great question, Matthew. You're asking a question, Matthew. You're also asking a question about insurance. And you're asking, do we have any plans to revise our larger deductibles for wind and hail in Oklahoma properties? Let me tell you, it's a deal breaker for us. It's got us tied in knots right now. We're not happy because this is something new that just occurred recently to us, and it raised the price of all of our properties and it's not due to any, the fact that we have to have a higher deductible in Oklahoma has nothing to do with us or our portfolio. It has everything to do with other insurance companies and the back end insurers that are providing that high risk coverage. They're forcing that on us. So I don't know. We've been encouraging our own team and encouraging clients to go and research. Can they get a better rate? Because you have to. I mean, you got to be smart with what you're getting on your deductibles to see if there's something better there. But I'll also kind of flip the script just a tad on one thing that, like for me, that higher deductible doesn't bother me right now because I've never filed a claim. I haven't had to, not for wind and hail, certainly. And that's just, I don't know enough about, is it for other things as well? Is it for the global coverage is $15,000 deductible, or is it just for wind and hail? I don't know the detail. I apologize. But what I do know is that, again, that's a high threshold should you have to make a claim. And I fully understand why any investor would say, look, that's just too high. It's too high for us. We do have plans to get that remedied, and we're working on it. It just may take us a little bit longer than what we anticipate. But we do have plans, and that is something that's on our radar. That's just, we want to be better than that if we can be. So far, we're unable to provide that service at a better price, and so that's a great spot for us to continue to work to get better. Great question. So, so I thought that was a great, Alvin Gu made a great statement in here. I want to make sure I touch base on it. He's saying that his particular provider would not provide an umbrella policy against anything that they didn't have the currently under insurance. Alvin, I didn't know on that. And I don't really have a response to that. I don't know. That's something new on me as we begin to learn who will and won't do things. I'm sure there's insurance companies that will, but maybe not. So I'll continue to do research. I'm going to look into our own insurance program and see if we can provide umbrellas as an additional add-on service. Don't be looking for it in the next week. Don't send me any email saying, hey, do we have the umbrellas yet? I don't know about that. I'm going to work on it, but I will get an answer for everybody everybody in the group and on the call, because that's a great, Alvin, that was a really good share right there, because that's going to drive me to go out there and see what I can find out. And hey, Matthew, I'm with you 100%, man. I get exactly where you're coming from in Oklahoma. So Jeff asked a question about the current eviction moratorium in place, FHA-backed loans, just in the way you screen potential given. All right, so let me open this up real quick, guys. I apologize for having to read and look away while I don't mean to be distracting. Okay, so great question, Jeff. Look, here's the deal. Yes, we began to adjust the way we were going to screen back in March, and you are correct. It has nothing to do with credit scores. It has everything to do with where are you currently working, how long have you been there, kind of what do you do. These are things that we want to know to be able to judge their their abilities, then we do ask the questions of, do you have a second payer? Like I said, the 2 income earning family. They're more stable. So we have changed our qualifications. I wouldn't say changed. We just drilled in a little deeper. We're making sure we're asking a couple of other questions that maybe we hadn't asked in the past because they weren't as relevant, but they're super relevant right now with what's been happening with COVID-19. But also, let me tell you this: we did the math. We've been doing some work, and I'm gonna pull this up real quick and see if I have a better answer here just yet. If I have the data, I don't have it just yet, but this is what I do know. This is the data I was going to tell you. We have 59 residents, so that's less than 1% of our entire portfolio has been unable to pay for 2 months during COVID-19. So 59, less than 1%. Now, we have been able to see where about somewhere between 2 and 3% of our portfolio has been affected a little bit. They've had to get onto a payment plan. They've had to ask for a little bit of assistance, a little bit of work to be able to make sure they can get their rents paid. But only 59 have had 2 consecutive months where they couldn't make a payment. So we're not anticipating this massive influx of evictions. It's as of right now, we're not seeing that. The longer the pandemic goes, the more economic pain that residents feel, the harder it is for them to work or that type of thing. We may see other issues down the line, but if they stay this relatively small, then we're able to deal with them, in time. So in other words, we've got less than 1% we've got to work with right now that are having issues right now. We get them out of the home into something that they can afford, assist them with doing that with a limited amount of pain and suffering for them. Then we get into a resident back into that home that is qualified. Then we deal with the next set that are feeling pain further down the line. So if we can prevent this spike in move outs or evictions and just kind of keep everybody on this even keel of we'll just deal with you as you have issues, I think we're going to be okay. I would not. It's personal preference on whether or not you're moving forward right now. You're waiting to see what's going to happen with rents. I've done a couple of videos. In fact, there's still some of the stuff up here. That was said 87%. It said 87%. That was the amount of rent we collected through the 15th of the month that was billed on the 1st. So that is actually about a point ahead of where we were in April and May, and we anticipate being at around 98 to 98.5% of all billed rent collected during the month of June, which is, look, I talk to management companies all around the country. It's phenomenal. It's certainly outclassing many management companies and most turnkey companies. It's difficult to keep up with that, especially at our level. So I don't anticipate seeing a ton of issues down the line, but we have changed the way that we're asking questions. Here's one other thing we've changed. So somebody qualifies and we approve them to rent a house and they're going to close 4 weeks later. Well, right up against closing, we're confirming that nothing's changed. It's been 4 weeks' time. You're still employed. You still have the double income. You're still at the same spot. Everything's still the same. And of course, since we're signing a legal document, we're asking them that we're doing our best to make sure we're pulling the truth out of them when we're asking those questions. So great question though, Jeff. So let's see here. So Matthew, you're asking a very specific question there about our accounting team and the tracking of utility expenses. So I'm not going to have, I hate this, I hate to put it this way, and I fully understand that last sentence. So 2 quick updates. One, we have an accounting team that is on top of this. If you want, hey, let's get on the phone for a better breakdown of this. Ask your customer service team to if they can, or if they can connect you with somebody that can help you understand those charges to make sure that you're getting back what, you're getting credited what you should be credited, and that we're collecting what we should be collecting from the resident. When it's collected, it should be easy for you to be able to keep track of. If you're having any difficulty there, we are happy to jump on there and make sure we go through that and make sure it's all being done correct. I'll tell you number two, and look, this is straight up. We're human. If we make a mistake, you need to ask these questions. I'm glad that you're looking in there at your owner's portal. I'm glad you're looking at the accounting, trying to make sure you keep track of it, because we're human. If we've made a mistake, we need to make sure we get it corrected for you. And if you can't tell if we have or haven't, we need to get on the phone with you. So Matthew, look, that's what the customer service team is there for. Ask them, get an appointment to review it to make sure that everything is correct. If you're having any issues with that, if anybody's not being responsive, you reach out to me. I'll take care of it, okay? Because, and I doubt that's going to be the case, but if it were, you have a direct line into us, you just come in here and ask. I'll be more than happy to help you get an understanding and make sure the accounting is correct. And of course, if it weren't, that would be corrected immediately. But just the same, I want you to have that high level of confidence that you understand what it is that's happening there. Lastly, as far as the portal is concerned, Jerry Statham, y'all met him last week on the call. Jerry is pulling his hair out today, but he's close. Look, we are very close, much closer than we have been at any point in the past at the rollout of our custom-built property management software that will have a forward-facing interface for you guys as clients to be able to get into one portal to see all of your portfolio, and it's close. We have, of course, in order for that to work, you know that we have to build everything on the back end. And I don't mean the back end. I mean that we had to build, he had to make sure that we've got the system built for identifying and buying the homes, and then the process of renovating the homes, and where do we store all the pictures, where do we store historical data on every single property and everything that was done to the property and who did the work, and then the sales side of it on who it was that purchased the property and has it in their portfolio. That's got to carry over to customer service. So really, they have been building an amazing system, and we're close to it, okay? So anyway, I did want you to know, because I know that you've asked this in the past, Matthew, that we are going to absolutely get this done, and it's going to be I can't tell you the level of improvement it's going to be over what we currently have. So until then, keep with your customer service and ask your questions. Make sure we get the answers for you from there. Look, all right, so now how's it been? It's been an hour. I'm going to go ahead and jump off this call now, unless anybody's got any final questions. If you do, and I happen not to get to it, guys, throw it in there. I'll answer them at a later time. Be sure and, hey, communicate with each other in there. This really isn't a group just for us. It's a group for you. No solicitations, don't offer any services, nothing crazy like that, but talk to one another. I mean, especially if you're interested in getting started and want to know how to. There's lots of clients here that you know, in a controlled environment like this, I'm sure that they're willing to help and sure that they're willing to answer some questions. So be sure and ask them. Guys, tomorrow, 2 p.m., same time, Kent Senior, 2 fantastic clients. If you want to jump on here on a show either with me or Kent Senior, do some question and answer, get interviewed by him for the Experience Matters Live, let us know. We'd love to have you on here. This is for you and for us. So let's get out here and have some fun and do some connecting. Until then, tomorrow, guys, have a great day. If we can do anything for you, please sure and let us know. Everybody stay safe. I appreciate you joining me. We'll see everybody later. Thank y'all.